When deciding whether to resort to debt or equity for financing long-term funds, companies must evaluate several factors. The choice depends on the company's financial position, market conditions, and strategic goals. The following are the critical factors to consider. 1. Cost of financing. Debt. Interest payments on debt are tax-deductible, making debt financing more cost-effective. However, higher interest rates can increase financial burden. Equity. Equity does not require fixed payments, but the cost of equity, dividends, and dilution of ownership may be higher than debt in the long run. 2. Financial risk and leverage. Debt increases financial risk as the company must meet fixed interest obligations, regardless of profits. High debt can lead to insolvency during downturns. Equity. No fixed obligation to pay dividends, making it a safer option during financial stress, but it dilutes control. 3. Debt-equity ratio. A company with a high debt-equity ratio may struggle to obtain additional debt without raising its risk profile. A balanced capital structure is critical. 4. Ownership and control. Debt allows the company to retain ownership and control since lenders do not gain voting rights. Equity. Issuing equity leads to dilution of ownership and may shift control, especially if new investors acquire significant stakes. 5. Cash flow stability. Companies with stable and predictable cash flows can afford debt as they can meet interest and principal payments. Firms with fluctuating or uncertain cash flows may prefer equity to avoid financial stress. 6. Market conditions. Debt favorable in low interest rate environments. Equity more attractive during bullish market conditions when stock prices are high, allowing the company to raise funds at better valuations. 7. Growth prospects. High growth companies may prefer equity to avoid the burden of fixed repayments, enabling reinvestment into growth opportunities. Mature companies with stable income may opt for debt to benefit from tax shields. 8. Tax considerations. Interest on debt is tax deductible, reducing the company's taxable income. Dividends paid on equity are not tax deductible, making equity less tax efficient. 9. Creditworthiness. Companies with strong credit ratings can secure loans at lower interest rates. Firms with low credit ratings may find equity more accessible, albeit at the cost of dilution. 10. Regulatory environment. Regulatory restrictions may limit the amount of debt a company can raise. Equity issuance may require compliance with disclosure and governance standards, especially for public companies. 11. Flexibility. Debt. Fixed repayment schedules reduce financial flexibility. Equity provides greater flexibility as there is no obligation to pay dividends. A company should assess these factors in light of its strategic goals and current financial situation. Often, a balanced mix of debt and equity, optimal capital structure, is preferred to maintain financial flexibility, minimize costs, and maximize shareholder value.